between what's happening in technology and crypto, this is the greatest macro trade of all time, and it's not over yet. It is economically the most disruptive force we've ever seen. It is a nuclear bomb when it comes to deflation. People just have no comprehension of how big this thing is. How do you allocate your capital between the two? This year, it's been technology stocks. Last year, crypto massively outperformed. So what do you hold over an extended period of time? A bit of both.
Today's market environment, late November, is defined by a kind of liquidity air pocket. Markets aren't falling because of a collapse in fundamentals or a dramatic macro shift. They're falling because liquidity has been temporarily sucked out of the system. Here's what's going on behind the scenes. Because of the U.S. government shutdown, the Treasury built up its Treasury General Account, the TGA. This acts like a giant vacuum cleaner pulling liquidity out of markets. Normally, the draining of the TGA would be offset by liquidity from the Reverse Repo facility, but the RRP is already drained. On top of that, quantitative tightening is still happening.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
You know, where we are today, what day are we? We're on the 20th of November talking today, and market's puking. And it's been in that weak trend. You know, I've been looking at this for a while, and there is this mismatch of liquidity that's happening at a macro level that's causing a lot of the issues we're seeing right now. And that is, you know, without getting in too deeply into the weeds of it, basically because of the government shutdown, the Treasury built up its general account and has not been able to really drain it yet. And there's no offsetting buffer because the reverse repo's drained and we've got QT going on. So we've got this kind of sucking of liquidity out of the system that really has affected the highest risk assets further out the curve, and crypto is that. Technology has been kind of volatile because of the same reason, but it's been held up somewhat by buybacks and also held up by the generally, I think 80% of all fund managers were below benchmark. Because they've missed tech, because all the way through they said tech's a bubble, AI's a bubble, AI's a bubble, and they've missed the whole move. And so that's dramatically affected performance. So they've been performance chasing, which kind of meant that NASDAQ outperformed for a period of time. But it's this liquidity thing. Liquidity, we found in our work at Global Macro Investor, using the total global liquidity explains 95% or 97% of NASDAQ's price movements over time since 2012 and 90% of Bitcoin's. So it is the single most dominant macro factor, and most of the explanations lie therein. So on the macro side, the business cycle, which is the main kind of driver of everything, has been very subdued for this entire cycle. And that's been driven by the high rates environment and the liquidity environment. If you, on a forward-looking basis, understanding all of the fiscal stimulus that's coming, plus liquidity stimulus that's coming and the probability of rate cuts coming, the chances are the business cycle is going to be a lot stronger going into the election year. Don't forget, we've got Scott Bessent running the Treasury, who's an ex-hedge fund manager. He understands this game very well. So I think on a forward-looking basis, it looks great. But what you've got is this liquidity air pocket that means that there's not as much money around. So the people's propensity to take money off the table is higher. People are nervous. I mean, we've seen the fear index in equities be down at like 8, which is insane considering the market's barely off the highs. So it shows you there's some pervasive sense of fear. And so any movement in the market kind of gets exaggerated very quickly. And I think, you know, after the NVIDIA earnings, people just want to quickly take money off the table. And as you say, next week's a US holiday week. Things start calming down as well. And if you've had a decent year, you do want to protect it. But normally, end of the year is usually pretty strong. And considering they've got to drain somewhat of the TGA to pay for all of the employees they furloughed, etc., there's a reasonable amount of liquidity that will come into the economy over year end. Those drawdowns, again, are driven by liquidity. And Bitcoin is crypto is the most affected by liquidity of all of the risk spectrum of assets. So it tends to go down. It's also an earlier stage network adoption model, like Amazon went down 95% in its first cycle, stuff like that. Over time, networks as they get adopted have less volatility because there's more economic activity and less, and it tends to be stickier over time. So my guess is the next time we have the liquidity down cycle, which I think is more likely to be 2027, we will see less of a drawdown in Bitcoin than it was previous cycle. And we've seen that pretty much every cycle, that it's had less of a drawdown. My first cycle, I think Bitcoin was down 87.5% back in 2013. And then it was down less in the next cycle in 2018, whatever. So it kind of fits to me that over time, but when you go further out the risk curve, so if you've got a newer token that's smaller, it's going to fall 90%, as they always do. So I don't think that changes anytime soon. It's just the question is, are we starting it now, which is what some people think, because they think that the 4-year cycle in crypto is the most dominant factor. And I would say, no, it's driven by the debt refinancing cycle. So it's just two different ways of looking at it. And, from what I can see, we've got 10 trillion of debt to roll over the next 12 months. If you're rolling 10 trillion of debt, you're going to need some liquidity to do it. So in which case, it's hard for the market to go down. Bitcoin has outperformed, or no, the NASDAQ has underperformed Bitcoin by 99.97% since 2012. So it's been a one-horse race right now. I call it the supermassive black hole. Will that always be prevalent? Maybe not. But it's very difficult. There are some clear winners that have done better. So NVIDIA has done well over that time, stuff like that. So again, all I do with that bet is this is all the same thing. The world is about to become more digital tomorrow. And these are the two mega horses in that race. How do you allocate your capital between the two? Depends on your risk profile, and depends on, what has got the relative kind of attention thrust or momentum at any one period of time. This year, it's been technology stocks. Last year, crypto massively outperformed. So what do you hold over an extended period of time? A bit of both. But listen, between what's happening in technology and crypto, this is the greatest macro trade of all time. And it's not over yet. So to try and get too cute with it is hard. And I'm able to stomach the volatility and have the cash flows to do it. So I don't need to do it. But for other people, just manage that risk because it's not easy. In crypto, there's two different levels. One is, go back to its liquidity. So liquidity has hit crypto more than anything else. And that is the FedNet liquidity that has shrunk. So it's hit that. But then we've got OG profit taking we've seen. So that continues. And that kind of makes sense. And you've got this pervasive opinion that the 4-year cycle is what it is. And therefore, you must sell in November and go, October, November, and go away and come back in, 12 months' time. So there's that pervasive feeling. And then there's, I think, somewhere there is some damage that was done during the October the 10th flash crash in crypto. Now, I don't know if there's a body there, but my guess is the balance sheets of some of the market makers are impaired. So it means that they can't provide as much liquidity as they have done, which exaggerates price moves. I think that probably makes sense. We're also seeing some unwinding of the token holdings by the DATs because of the construct that they've got. They buy back their equity. So, that's ugly, and that will probably continue if price action continues like this. So you've got this supply going on, less liquidity around because of the Federal Reserve and the Treasury, and less liquidity in markets because of impairment after October 10th. Makes it just feel not great.
Raoul emphasizes that crypto performance this year has been lackluster only because liquidity has been lackluster. When liquidity expands, crypto expands. He continues to focus primarily on layer ones and avoids going too far out the risk curve, following his "don't screw this up" philosophy. Network adoption plus liquidity macro tailwinds equals the core strategy. And he believes the full business cycle, not the Bitcoin halving cycle, is the true driver of returns. If the business cycle accelerates in 2024, as indicators suggest, crypto and tech could experience explosive upside.
Well, after AGI comes, it is not us making the discovery, it is it. Right? This is the scaling of intelligence to infinity. Intelligence is what we have been paid our careers for. our intelligence goes to zero in value over time. Doesn't mean we go to zero in value, but that particular aspect of what we do. So it is the most profoundly disruptive technology the world has ever seen. It is of civilizational level importance. Of the importance, it is the largest game of nations we will ever see played, because nobody can allow the other side to win this. So more than nuclear proliferation, this endlessly scales. And so, I know people didn't like it when Sam Altman talked about government backstops. There is absolutely a backstop. There is not a single way the US or China would allow their industry to not succeed. So that's how big this is. It is economically the most disruptive force we've ever seen. It is a nuclear bomb when it comes to deflation. People just have no comprehension of how big this thing is. So for me, it depends on your time horizon. I mean, I don't look at it in year-to-year gains. You look at it full cycle gains. Full cycle for me is the business cycle. So it's not necessarily the 4-year Bitcoin cycle. So you look at the gains over the cycle, and over time they compound. So here we've had a year which has been pretty lackluster. It's gone nowhere at Bitcoin level. But at Bitcoin level means that everything below that has underperformed. And I get it. It feels terrible. I've been lucky enough most of the way through. I mean, I haven't been in Bitcoin all cycle. I've managed to outperform it via just having the right asset allocation. Bought Solana at the lows and then switched into Sui when it had its run. And it's given a bit back, but generally that's worked fine. I'm not a big fan of going too far out the risk curve. I have this whole don't fuck this up thesis. And a lot of it is every time you think you're really being smart out the risk curve, your probability of success is pretty small. So I tend to stick with layer ones generally, because it's definable. I understand the metrics, I understand what drives them. And then, if I look at my wallet of shame from when I've allowed myself to FOMO in on stuff, I allow myself up to 10% of my portfolio to do that. I probably never even get to 10% because it's just not my comfort zone. If I look at it, every single trade I did lost money. It's exactly what the ISM is telling us. The ISM survey has been below 50 the entire cycle. It's the lowest, it's the longest period of below 50 ISM. So that's no real economic expansion in history now. And so that is exactly the K-shaped recovery, because what we've got is this massive capex boom going on in the hyperscalers and the AI space, some government spending, and then other than that, the economy's pretty flat. So you're seeing it everywhere. You know it from everywhere. It's one of the reasons why retail haven't come in crypto, because they don't have any disposable income. Real wages are still pretty low. Economic activity for most businesses is not great. And this is the thing that Scott Bessent's been talking about, is how do you increase Main Street activity? And that is what has to happen. That's the rate cuts. That's taking taxes away, not paying taxes on tips and things that run the basic services and the basic economy of which most people live in. So, I think the read of, Chipotle or whatever is dead right. And that is what I think the Trump administration will focus on to try and get the midterms through. And I think they really understand this game. AI is not the most easily investable theme, really. We've got hyperscalers, but you're buying other cash flows in other parts of the business. So it's not a clear bet. Yeah, Nvidia, but it's scary to be in a very, very crowded big bet. I get it. It's a great trade. I have no issue with that. But the nexus of AI and blockchain is huge. Blockchain is the technology rails by which all of this will operate. It's the new layer to the internet. As we roll out millions and then billions of agents, again, need payments. They need payment for what? Energy and compute, the same flywheel. So the energy and compute costs need to be paid, and maybe there's a profit margin if they're set up as businesses. And the instantaneous requirement for payments requires blockchain rails. Also, in a world of such deflationary forces, you need to have the ability to have scarce assets, right? Because in a digital world, nothing is scarce. So blockchain solves digital scarcity, which is a really important factor as we become increasingly digital. So these technologies are incredibly important, and they interact together. How do you invest in it? your job is to basically look at one chart versus the other and say what's going to outperform over time. It has been, if you look at it. So again, liquidity has been relatively lackluster so far this cycle versus every other cycle. And that's given us relatively lackluster prices. So I don't really have an issue with that. If I overlay US total liquidity on total market cap of crypto minus Bitcoin, it's pretty much identical. So it's telling us liquidity has not gone to new highs yet, so crypto hasn't gone to new highs. And that's total liquidity, not rate of change. So yeah, I don't really, it's not something that's concerning me in that respect, I think.
Yeah.
You know, and also people don't realize that enormous amounts of those ETFs is actually just arbitrages. So they hold the spot and sell the CME futures. Some are doing the perps, not many do the perps, but that trade is gigantic. And that's where a lot of the volume comes from. So the total actual buying by institutions and retail, significant. But again, if we go back to the business cycle, people's free cash flows in the normal world outside of tech have not been great yet.
Right.
And so therefore you can't recycle those cash flows into markets. And so if my thesis on the business cycle is right, we'll see that rise significantly. If it's wrong, we won't.
And that wraps up this expert-level breakdown of Raoul Pal's latest macro analysis. At its core, the message is clear. Short-term pain is a liquidity artifact. Long-term opportunity is bigger than ever. Crypto, AI, and exponential technologies sit at the center of the greatest macro trade of our lifetime. And despite volatility, the structural forces powering this decade's digital transformation are still intact and accelerating. Raoul explains, in a purely digital world, nothing is scarce, except what blockchain makes scarce. Digital scarcity becomes essential in a world with infinite AI-generated supply. This creates what Raoul calls the nexus of AI and blockchain, and he believes it is one of the most powerful investment themes of the next decade.